Kia ora, morena everybody, and welcome to the Responsible Investment Benchmark Report Aotearoa New Zealand launch for 2022. Tēnā koutou, tēnā koutou, tēnā koutou katoa, no whakatua hau, ko hekati te whānau, ko dīna hau, ka nui te mehe, kia kātou, tēnā koutou, tēnā kātou, tēnā kātou katoa. I'm Dean Hegarty, the Executive Manager of Membership and Engagement at RIAA and the head of the Aotearoa New Zealand branch. And it gives me great pleasure to host you this morning. The report is RIAA's flagship study, and it measures the size, the growth, and the performance of responsible, ethical, and impact investments within the country each year. It's the place where we're able to best understand and quantify the work happening across the industry, the outcomes being delivered, and the trends that are emerging. This morning, we're going to hear first from the study's author, who will deliver an overview of the key findings from the report. This will then be followed by a panel discussion with industry experts, and there will be plenty of time to answer questions. So as we go along, please feel free to place your questions in the Q&A function, and we'll endeavour to get through as many of those as we possibly can throughout the discussion. So without further ado, I'd like to warmly introduce RIAA's Manager of Research, Zsuzsa Belhami-Zakar. Zsuzsa has an extensive track record as a researcher, spending 9 years in academia. She completed a PhD in sustainable finance and worked extensively with investors and the not-for-profit sector in the region on topics such as climate adaptation, blue finance, and the identification of environmental risks and opportunities. Welcome, Zsuzsa.
Thank you, Dean. Good morning, kia ora, everyone. I would just like to say how excited I am to be presenting the New Zealand report's key finding this year. We have plenty of very interesting and exciting findings. And let's get started. Next slide. Thank you, Bryony. Domestic and international context. So one of the things that we include in the report is a section on the international and always the relevant domestic context. This serves as a summary of what has happened in 2021 over that 12-month period. We start off with the New Zealand developments. I just pulled out highlights here for you. There's a lot more detail in the report. But some of the key things that have happened is the default KiwiSaver provider excluding investments in fossil fuels and some weapons, mandatory reporting of climate-related financial risks commencing in 2023 with some legislation passed, Toitu Tahua Center for Sustainable Finance established by the Aotearoa Circle's Sustainable Finance Forum, and several investor toolkits by RIAA that were launched in 2021 by the Human Rights Working Group, First Nations, and nature working groups as well. So for more information, please see the report, but also the RIAA website for some of those investor toolkits. Global, if you can skip back, thank you. Global developments, look, these are the substantial ones that will be definitely felt in New Zealand. The International Sustainability Standards Board begins work on the framework for climate and ESG reporting. CFA Institute develops global ESG disclosure standards. So a lot of work around disclosures globally. Green taxonomy in several jurisdictions. Task force on nature-related financial disclosure, and other legal efforts to combat greenwashing. So a lot of activity in terms of regulations, both in New Zealand as well as internationally. And we see the impacts of that in the findings of the report this year. So next up is the slide that sort of summarizes the report methodology and gives a bit of background into the language and terminology that we use. So here we have basically the yellow section is the total market for New Zealand, standing at 365 billion total funds under management. The blue section of 326 billion, that's the research universe for 2021. That's the coverage of all the organizations that were included in our study this year. So I'm really, really happy with that. That's really close to the total market. So we're inching in, definitely moving in the right direction. And then the green section is the responsible investment AUM at a record 179 billion. This is made up of the contributions of the 19 responsible investment leaders, and only the contribution that is designated as invested responsibly by those leaders. So it's a conservative amount, and that's just the methodology that we've used over the last few years. The research universe was made up of 52 entities. This is always a bit tricky and difficult for us to actually draw the line around the New Zealand market and those that are included. We have about 40 of those organizations are headquartered in New Zealand. 10 are international, but they have investments in New Zealand that are designated for New Zealand, as well as we have 2 organizations that are headquartered in Australia, but also invest significantly and have products in New Zealand. So the research universe is made up of those that filled out the survey. A huge thank you to all 28 survey respondents. This is much improved from last year, and this really helps get much more of a rigorous and insight, and we're much more confident in the data with so many survey respondents. 24 of the organizations we do a desktop evaluation on. So we don't basically fill out the entire survey, but some select questions, such as we score them on the scorecard so we can determine if they're leaders or not. And then some other activities around policies and practices that we also fill out for the desktop. So that's in a nutshell how, what we do. That's the methodology behind those numbers, and some of the reasons why we ended up with the results that you see today. Responsible investment market growth. I'm so excited because look, the responsible investment AUM is nearly half of the market, so standing at 49%. A fantastic growth from 43% the previous year and compared to just 38% in 2019. What does this mean? We actually see that the remainder of the market has stayed the same, even though the total market has grown. So we see a 6 percentage point increase in responsible investment AUM, pretty much at the expense of the rest of the market. So that's definitely a headline finding for us, and really encouraging. Next up, so we delve into a little bit more of a detail on the various practices of responsible investors. This slide just introduces and talks about the certification, which is an independent third-party verification system or a certification program at RIAA. So because it is our program, we have a lot more data on the certification. On the right-hand side in the graph, you'll see the percentage of the different asset classes represented by products certified. So the bulk of the products that are certified are diversified or multi-asset products, international equities, and Australian only equities. Then we have fixed income, cash, alternatives, emerging markets, and property. So what I wanted to show you with this figure is the diversity of certified products. It is not just 1 or 2 asset classes. We're starting to see more and more different asset classes represented and represented well in these figures. In New Zealand, we have 109 certified products compared to the total certified products we have of 218. In 2021, the number of products that were certified in New Zealand were 14 that were domestic and 26 in total with some of the international products. So that's the certification summary. Next up is the performance table. I've put in a couple of little arrows there just to indicate the benchmarks for our performance measurements. So each year we rely and we ask our partner Morningstar to provide us with this breakdown. So we see that we have 3 asset classes where we can measure performance. This is where we have the most responsible investment and certified products in these asset classes. This is multi-sector growth, international shares, and New Zealand share fund. We use different benchmarks, and benchmarks are it's the best that we can do, and we picked Morningstar for consistency over the years. The 2021 market was much different to the previous year, the 2020 market. We see a lot more activity, a lot more pickup after COVID. So there's some changes there if you feel like going back to the previous year's report and having a look, you'll see the magnitude of difference there. But what is important here are the colors. So the green colors designate overperformance of about more than 1% compared to the benchmark provided by Morningstar. And then the yellow is within plus or minus 1%. So what we see here is, first of all, that the RIAA certified products shows a significant outperformance compared to the benchmark. This is a smaller group of products, so just remember, bear that in mind. The responsible investment products also show at least staying on par or outperforming the benchmarks. This is particularly, take a look at the longer term time horizon, but we're also seeing this on the medium and shorter term as well. So some interesting and encouraging find for those that are interested in the performance of responsible investment products. Next up is a section that deals with each of the different responsible investment approaches in more detail. In this figure, this is again sort of a central figure in the report. What we're showing is how much, what is the value of assets under management in each of the 7 categories. The categories that we use are based on the Global Sustainable Investment Alliance categorization. So we have negative screening, ESG integration, corporate engagement, and so forth. Those are the major categories. We asked survey respondents to designate how much of their assets under management actually how much of that applies negative screening or ESG integration. So what we see negative screening as the top ESG, as the top responsible investment approach, with a growth from 161 to 197 billion. ESG integration coming in second, also showing a growth. Corporate engagement and shareholder action, also showing a growth. Sustainability themed investment, I'll talk more in the next few slides. We see a substantial growth there, and that's very interesting. Norms-based screening, we see a drop. Impact investing, again, we see a growth, and positive or best-in-class screening, again, a drop. So some reshuffling around there. No doubt the impact of some of those new regulations that have come in. So going one by one from the sort of the biggest volume of AUM, we start off with negative screening trends. Look, I talked about the increase. On the right-hand side, you see the different categories that investment managers have designated. What do they screen out? So they're most likely to screen out tobacco, controversial weapons, gambling, adult entertainment, and all weapons, nuclear power, and so forth. What is interesting, so, I don't have a lot of time to go into detail into these. What is interesting to me are some of the new categories that have emerged. So where you only see the green bars, which is the data for 2021. So we see countries or zones with government integrity or corruption issues emerging, violations of the rights of Indigenous people emerging. We see intensive livestock management, palm oil production. So we see those new categories, this diversification of the screening. All right, next up is ESG integration trends. ESG integration remains a central strategy for most investment managers. Again, it's increased. The coverage of ESG integration is expanding. That's what this chart shows. The green bar designates the proportion of AUM that is more that incorporates ESG integration to a greater extent. So it's at least 85% of AUM, there's a list of different asset classes. So equities, fixed income, corporate, and fixed income sovereign. So what we see is that those that have started to ESG integration, maybe with a single asset class, have gradually expanded their ESG integration practices to cover more and more of their AUM and the different asset classes. Still, the red bar, this is similar to what we found in Australia, that there is a proportion of investment managers that do not apply ESG integration as a strategy. So if people think that this is some sort of a progression of, you have to do ESG integration first and then you move into negative screening, et cetera, that's really not what we're seeing here. What we're seeing is that that there is a segment that is deciding to forego ESG integration perhaps altogether and apply different approaches to their investment. Next up is corporate engagement and shareholder and action trends. There's a lot of activity already on stewardship in New Zealand, but there's probably more to come. So I see this as a start of a trend with an increase of 9% to 167 billion. In Australia, we already see stewardship and corporate engagement coverage growth, really tremendous growth of 54%. There are lots of questions we ask around corporate engagement to get a better understanding of what is going on. What does corporate engagement look like in practice? So we ask questions around voting, and we see that 62% of investment managers vote across all possible holdings, 70% of vote on material issues only. We see that the way that corporate engagement is demonstrated to the public is through reporting practices. Now, reporting includes reporting on activities of engagement, but we're also wanting to see outcomes. So what are the outcomes of those engagements? And what we see here over the last 3 years is a growth in reporting of activities and outcomes. So those that are reporting or have reported on activities are now also including reporting on outcomes. So that's really encouraging. There is still a proportion of those that do not report. And there are lots of reasons for that. We can definitely talk about it in the panel section if that is of interest. 36% of survey respondents directly engage with investee companies. That's another question that we ask on the survey on information. So that really supports these findings. That was a growth as well. Still 46% of investment managers rely on external ESG and sustainability data providers. Next up is our trends in sustainability themed investments. So we see a significant increase from 18 to 40 billion in 2021. What do these sustainability themed investments look like? Well, they pick certain themes or areas where they want to see investments and focus on those. The top focus is climate change. No surprises there, I believe. We see the investment in natural capital drop compared to last year, which was interesting. I don't have any explanation as to why that is, but maybe those that operate in the market might. But we do see other categories emerging. So we see investment increase in green property, waste management, sustainable transport, and healthcare and medical products. Now, sustainability themed investments this year include $1.9 billion worth of sustainability linked loans or SLLs. This is the first time that we're able to collect information on SLLs and include them in the sustainability themed investment side of things. So that's really encouraging. And we see the growth in those types of loans increase also in Australia. So it's definitely something that is going to stay on our radar. Next up is the norms-based screening trends. Now, this is where we see a drop. It's not a very common approach in our region, in New Zealand as well as in Australia, compared to other parts of the world. New norms that were included in our list, we're trying to get more granular data as to what's going on, include the TCFD and EU taxonomy regulations. So obviously, norms-based screening now not only includes the main UN international treaties, but various other initiatives as well, probably trickling through from the international headquartered investment managers. The drop in norms-based screening could be a reflection of the sort of enhanced regulation and policies in New Zealand compared to, let's say, Australia, where it's no longer a norms-based screening, but just a straight out negative screening. So some reclassification there is possible. Impact investing. So impact investing increased by $5 billion to reach $8 billion. Impact investing remains dominated by various green bonds, climate bonds, social impact bonds. The top themes for these included affordable housing, probably no surprises there, I guess, healthcare as well, climate change, renewable energy, green property, and agriculture. So those were the main themes that these impact bonds are targeting. I also included a graph here that just shows you the different product or the number of products in each of the different categories. And I pulled out Kauri bonds because they were sort of an interesting area. But this is, all in all, this is a significant growth in the right direction for impact investment. Lastly, we have positive screening trends. Now, positive screening dropped. This could have been a result of reclassification. So we changed the way that we asked some of the questions around impact investing. For instance, we included some screening questions in our methodology so that we're not confusing investments with impact investment, which is a specific a type of investment driven by intentionality and some hard metrics around impact. And so we included some screening questions, and then we were able to reclassify some of the answers to the right categories if that was needed. So some of those ended up in sustainability themed investments, and some of those might have ended up in positive screening trends. So here we see investment is primarily focused on leaders, picking leaders and best-in-class trends. The top environmental themes are renewable energy, energy efficiency, transition risk, and physical risk management. The top social themes are related to gender and diversity and human rights. Again, we see emerging themes, green property, circular economy. So some of those things are coming along in basically in all the areas of whether that's sustainability themed or negative screening. We see all of those topics continually or consistently emerging. Next section is around a few questions to the survey respondents around practices, so attitudes and practices towards responsible investment. So I just summarized two charts here. They appear as two charts with a little bit more detail in the report: key drivers and deterrents to responsible investment. Key drivers here are, well, the significant increase or change compared to last year is what's in green. So growing interest by underlying investors at 45%, demand from institutional investors, 45%. Growing acceptance that ESG impacts financial performance stayed relatively the same, so no significant change there at 45%. Improved long-term performance, that is becoming a key driver. Demand from institutional investors stayed the same, and the desire to drive social benefit also increased. So we see some changes in perspectives there. Now, if we look on the other side of this, we see the key deterrents. Key deterrent number one is lack of viable products. Performance concerns stay the same. Lack of demand from retail investors at 20%, also similar to last year. Interestingly, lack of legislative requirements has increased to 20%. I mean, coming from Australia, I think New Zealand has plenty of legislation compared to us, and yet still this is, for the domestic market, there's still some lack in that regard. Lack of trust and greenwashing concerns are the same as last year, or approximately at 20%, and lack of qualified advice and expert has increased to 15%. And I think this is a really great summary of the current sort of issues, and that really this market growth that we see has created a market and a demand for ESG and responsible investment products. Coupled with that, you need more experts, you need more resources. Regulation helps cement and drive the, I guess, the argument or to make the business case for some of these new products. You know, on the other side, there's also a squeeze with the demands from institutional investors and other underlying investors. So that summarizes the report to the point of the responsible leaders. So each year we announce responsible investment leaders based on the prior year's activities and performances. You know, there's a definition there. The leaders that are members of RIAA have the chance to display a logo for the year. And just to reiterate that, we have a scorecard that we use to assess all of those institutions and organizations in our research universe. This scorecard is actually part of the appendix of the report. If you're interested, you can have a look there. The pillars that we cover there are, you know, basically all aspects of responsible investment, from policies to allocation of capital, including corporate engagement and shareholder action, active ownership, and ESG integration or various risk management strategies. So it includes all of those aspects. We use that to score the entities. Those that fill out the survey get the bonus of filling it out themselves, and then we of course check that is correct and reflects the organization's performance. And so we come up with you know, with a certain number of leaders, the number of leaders that scored high on the scorecard were 19. They scored 15 or better on the scorecard. The blue bars designate the emerging leaders. So we created this new category to recognize those that are moving in the right direction. They haven't quite made it yet. So they score between 14 and less than 15. And then the yellow bar is basically all of the investment managers that did not meet any of those two categories. So this is the part for the drum roll. So the responsible investment leaders in New Zealand for 2022 are displayed on this slide, along with the emerging leaders. So a huge congratulations to these organizations who've done a tremendous effort and continue to improve their practices year after year, and staying engaged and yeah, just moving in the right direction, I guess. So with that, I think I'm happy to conclude my presentation, and I think I hand it back to Dean.
Wonderful. Thank you very much, Yuja, and congratulations on crafting such a detailed report. There's clearly a lot in there for us to unpack in more detail, and so I'd now like to introduce our panelists to join me for a deeper dive into the report findings and some of their views. First, I'd like to introduce Pip Best, who is the Oceania Climate Change and Sustainability Services Partner at EY. Pip, who many of you will know, is a core member of the Sustainable Finance Forum Secretariat. She has worked with both the public and private sector in understanding the impacts of climate change and other sustainability issues such as emissions trading, green bonds, sustainable finance, impact and outcomes measurement. Simon O'Connor, the CEO of RIAA. So in addition to his role as CEO and director of RIAA, Simon is a working group member of the Toitū Tahua Centre for Sustainable Finance, the chair of the Global Sustainable Investment Alliance, as well as a member of the National Advisory Board on Impact Investing in Aotearoa, New Zealand. And finally, kia ora, joining us from stateside is Erika Kinsella, the Senior Vice President and ESG Product Strategist at PIMCO. Erika is a member of PIMCO's Client Management, Inclusion and Diversity Council, contributing to the firm's investments in inclusion and diversity, and previously covered financial intermediaries offering retirement investment solutions. Prior to joining PIMCO in 2020, she was also Vice President at Goldman Sachs Asset Management in New York and has over 13 years of investment experience. Thank you so much for joining us. Erika, I might start with you if that's okay. Be really keen to get a sense of what stood out to you as being either the most important thing in the report findings or perhaps the most surprising thing.
Yeah, happy to, Dean, and thank you everybody for having me on today's panel. I'm really excited by the results and the discussion today. So, I think that there were many interesting takeaways that came through in the reporting data, but a few trends that caught my attention relate to, I think, transparency and also integration. So, ESG and sustainable investing is really experiencing an accelerating pace of evolution. We really see this come through in the steady growth in the AUM figures, as well as new products and different strategies coming online. But, importantly, the growing interest and demand in asset growth without process documentation and without transparency can really raise concerns around greenwashing, which was a key deterrent that was covered in the key takeaways there. So, I think it's really good to see substantial increase in policy disclosure among investment managers and seeing that gap between those that are publicly disclosing investment policies versus those that are not, to see that narrowing. And I think that transparency is good for investors, but also the industry more broadly. And then I think the other interesting data point is on ESG integration. As a fiduciary, a robust research and investment process should really consider all factors that have the ability to affect a company or an issuer from a fundamental perspective. The increasing awareness among investors that ESG factors may be material to that process, as evidenced by the increasing growth in coverage of ESG integration in the reporting data, and in particular, what we saw there with the integration across asset classes. That's a really important recognition that ESG may be increasingly recognized as an essential input alongside a variety of other fundamental and financial inputs when evaluating long-term investment opportunities and risks. Again, the more information that can be assessed offers a more holistic view and potentially better informed decision-making for risk-adjusted investment decisions.
Wonderful, thank you, Erica. Pip, I might go to you next if that's okay.
Thanks, Dean. I guess just a couple of things that stand out to myself is maybe the nuances of the New Zealand market and how they reflect, I guess, some of the policy developments in New Zealand. So obviously negative screening being the most common of the different types of investment, lining up with new regulation around the requirement for negative screening. So not surprising, but making the New Zealand market slightly different to some of the markets like Australia and overseas markets. And similarly, I guess some of the other areas of development or expected development that we know are coming in the pipeline are things like the stewardship code, which I think we'll talk about a little bit more in a second. But in terms of reporting on corporate governance, I think we're likely to see that will be a place of big change in the coming years, more reporting on the outcomes of stewardship activities. And maybe one thing that surprised me was obviously New Zealand is, particularly maybe in terms of headline media, is thought of as very much a leader in the climate change policy space, with the mandatory reporting, climate risk reporting regime coming in next year. The negative screening on fossil fuels. However, we didn't really see that come through in terms of growth in climate change specific or climate change themed investments, which I found a little bit interesting, but potentially something that is to do with how we categorized different types of investments. So I guess there's a couple of thoughts from myself.
Yeah, wonderful, thank you. And Simon, you've done a number of these with RIAA now, and RIAA's certainly been doing this report for a long time. What were your kind of key takeaways?
Yeah, thanks, Dean. I think what really stood out for me is that New Zealand is specifically, as Pip called out, a market that has been dominated by a negative screening conversation for a long time. And I think we're seeing in the data this year this real indication that ESG integration and the role of corporate engagement is catching up rapidly. And that reflects to me a broadening and a sophistication across the full toolkit of responsible investors emerging and developing in the NZ market. And I think that's a really positive development for New Zealand. I think as we start seeing the momentum towards really strengthening action and response to climate change risk, it's going to be critical that the tools of engagement and integration are used much more in a much more refined and active way as part of the toolkit there. So it was positive to me to see that whilst screening still sort of dominates as the highest category by AUM, you're really seeing this ratcheting up of AUM coverage, but also the activity and disclosure and systems and processes around engagement in particular. So that's a really interesting development there that I think is the start of a shift. And as Pip alluded to, the stewardship code and that structure around that will help to sort of precipitate that and accelerate that, I think. I think that was really shown incredibly clearly by the doubling of fund managers in the last 3 years doing corporate engagement. It's a really big step up over the last couple of years, and then we've seen that play through in this data. What's really interesting to me too is seeing the rapid ramp up, albeit from a low base, in that more positively impactful end of that sort of spectrum of responsible investment strategy. So sustainability themed investing doubling year on year is a dramatic step up. Whilst it's still a small portion of the total pool, I think it's indicative of this appetite of investors to actually gain exposure to funds, assets, strategies that can actually deliver positive change. So we're sort of moving through this managing risk, avoiding harm, deploying capital for more sustainable activities and impactful activities. I think we're going to see that as one of the fastest growing ends of the RI strategies, sort of sustainability themed and impact ends. That's a dramatic shift, I think. And then thirdly, what just stands out is how important policy has been as a driver here. And I think we are in a state of play within New Zealand and indeed Australia and most parts of the world right now, where the policy acceleration and the regulatory catch up around this whole field is just incredibly rapid, and is having a big impact on the market, to the effect that, to the point where effectively we get into a point where ESG integration, as Erica called out, is sort of good risk management, good practices generally, and almost being built in to a market as just expected good practice in investment management, full stop. So I think that will, continue. And that's really driven, as Pip called out, a bit of a nuance for the NZ market too, such as the KiwiSaver default exclusion requirements and things, which we think will have sort of a flow-on effect well beyond just default Kiwi funds, to sort of broaden that, fossil fuel as an exclusionary sort of area across other funds as well. So they're probably the three things that stood out most to me.
Excellent, thank you. And it's interesting, both Pip and Simon, you talked about the negative screening, how much of an impact that was having. I'd be interested to get your view on, it's clearly something that has got a stronghold from a policy perspective in New Zealand, and it's something we see much more of, within the New Zealand market, certainly than we would see elsewhere in Australia and certainly globally as well. What are some of the impacts of having strategies that are so heavily weighted towards negative screens?
Maybe I'll jump in on that one, Dean. I mean, I think ultimately we're going to get to a point where the utility of negative screening reaches its sort of maximum extent, and when we start talking about transition and net zero, and we're going to need to go well beyond divestment to achieve any of these objectives, I think. So divestment is a blunt tool. It's been a tool in the NZ market we've relied on very heavily. It's been one that is really easy to communicate to consumers, good, bad, in, out. But in fact, it's not going to help us through much further beyond into a transition where we're really going to need investors to be at the table with companies they own, influencing for change. And so it's really critical that the market develops the skills beyond just divestment to help drive that transition. So I think we also are going to need to go through a process of educating the market, educating our customers, that it's doesn't solely come down to what's in your portfolio or out of your portfolio. It's much more complex than that. And we've seen numerous examples of investors having a very big impact on companies they own that could be deemed to be in the industries that are commonly excluded. But we need those investors to own those companies and to influence for change in those companies. So I think, the stewardship code that was recently launched at our conference, and we've seen some really strong early signatories, is really going to put some of the frameworks and structures around how we actually kind of substantiate what we're doing in engagement, not using engagement as a catch-all to hide behind, but actually, what was great in that data we saw there is people reporting on their activities and their outcomes. And we're seeing, and Juju's seen in both our markets, an increase in stewardship reporting and disclosure over the last year, which is great, because I think we need to sort of talk about what we're doing with our ownership. So I think there's going to be room for improvement in that. We saw one of the stats there, only 62% of those are voting all their holdings. That's still a pretty low level. That's a pretty basic part of stewardship voting. So so we're going to need to sort of increase all those elements, from voting to engagement to collaboration to advocacy, and considering how we deal with resolutions, etc. So more work to be done. We're going to still have a role for divestment and exclusions, but it won't be the end of the game, I think.
Thanks, Simon. Erica, I might go to you, and PIMCO, as an investor at scale in a fixed income space, what does negative screening look like in your area? And I guess the flip side of that is, how does engagement work for an organization like yours?
Yeah, so in fixed income, negative screens can really be applied in an investment process similar to how they're applied in equities. Screens can generally consider various issues that are misaligned with sustainability principles, such as prohibiting issuers, let's say, or restricting industries more broadly that may not be suitable based on an investor's values alignment or even sustainability themes more broadly. Examples might include issuers involved in tobacco manufacturing or controversial weapons production. We also saw in the results norms-based screening. So this could also be included, alongside more of those, fundamentally misaligned sectors, but, referencing globally accepted norms, such as the UN Global Compact principles, for example, in determining a universe of exclusions. Where fixed income differs in relationship to equities is really with respect to stewardship activities. Here specifically, fixed income managers use engagement as a tool to enact positive outcomes with respect to stewardship. As Simon mentioned, divestment alone is not going to be sufficient to address and really make progress on a variety of the sustainability issues presented to us. So it's really important that a program invests in issuers already demonstrating a deeply unified approach to ESG, but it's also important to really engage with issuers that are less advanced on sustainability practices, but who are also demonstrating a clear willingness to move toward better ESG practices and principles. And there's a recognition too that engagement is really a long-term, a dynamic process that's going to evolve over several years, and it's going to include many discussions of strategic sustainability issues and risks alongside company fundamentals, financial matters, and so in this regard, engagement can really be an essential tool in driving impact in ESG investing, as well as broader business fundamentals.
Thank you, Erica. Pat, you've got the most experience on this panel, certainly, of what engagement looks like in New Zealand. And we've obviously just launched the Stewardship Code. While we've seen growth and engagement in this report in 2021, it is still a long way behind the level of growth we saw in Australia, for example, and absolutely globally. What do you think is happening in New Zealand, and what do you think we can expect now that the code has been launched?
I think we're seeing, I guess, and it's not just specific to the engagement topic, but New Zealand is obviously quite a small market in terms of global scale, and there has been some resistance to additional red tape or green tape for things that aren't compulsory or mandatory, and so some things that are voluntary, such as we talk about stewardship code or engagement historically has been more of a voluntary disclosure, but if you expand this out to other things such as climate risk reporting, which up until next year is voluntary in New Zealand, it doesn't tend to be the areas that actually New Zealand leads in, which might surprise some people, but compared to some peer countries, and I think it's got to do a little bit with the size of the market and the cost of doing some of these things. So the efficiency factor, I guess, is the cost of doing those things compared to the size of the fund, etc., higher, I guess, is my point. But what we see happening is with things like the stewardship code being launched, we're changing really norms, and ideally with the first signatories and the first improvements in reporting, we will change norms in terms of what the expectations are on these things, and then hopefully that's where we do see that we get some of the smaller scale managers, etc., following suit, because they can see what is required, that kind of step to up reporting, etc., and up your engagement seems less overwhelming. That's my expectation, and I guess my view on potentially why New Zealand has lagged in some of these areas historically. I think there is a realization as well that internationally things are moving very fast, and norms are moving very fast internationally as well, and there is the need to keep up with what is happening internationally, so we do still become a really attractive place for investment, and really attractive to investors. So I think that is part of it as well. And one thing New Zealand doesn't lack on is ambition. So I think that doing something like the Stewardship Code and reporting, and doing better corporate engagement very much aligns with the values of New Zealanders. But I would actually be interested in Simon's view on this, given he has been, I guess, so closely involved in the development of the Stewardship Code, and what he sees we're going to expect in terms of its rollout.
Thanks, Pip. Yeah, like I think what it does, it sort of codifies what good practice looks like, and the expectations of kind of a shifting from quite broad discussion around engagement, which is really hard to communicate what that means to our consumers and clients, to getting really clear on the expectations of what stewardship and engagement activities are going to look like. So our hope is that does lead to a shifting of norms in the market, such that we see more stewardship disclosure, that we see improved reporting beyond just sort of activities, i.e. we voted our shares, we had some meetings to, really the thoughtful kind of strategy around engagement practices, around stewardship practices, and some of the outcomes delivered by that. I think the nice thing about stewardship is it can be molded to be fit for purpose for the size of fund manager and size of institution. It need not be an all-consuming program that has 10, FTE committed to it. So I think it's absolutely appropriate that there's smaller targeted stewardship activities from smaller fund managers or KiwiSaver providers. And I'd also say that even New Zealand has had an outsized impact globally in some of the collaborative engagements that have been driven from New Zealand. And the one that comes to mind most is the Christchurch call, and that NZ Super spoke about at our conference just recently. So I think what it's going to do is sort of codify expected practice around engagement. It's going to make it much easier for us as an industry to talk to consumers about how this practice of actively owning and influencing companies is affecting change, and allow us to kind of, move beyond just a conversation around what's in your portfolio and what's out of it. So, and it's really positive to see the deep engagement across the New Zealand market to date in the development of that code. And we've seen some founding signatories on board, and we expect to see that really driving some real change in the market over the coming year as well.
I think one of the other big findings from the report for me, we've seen RI products and RIAA certified products specifically really demonstrating superior performance over the long, medium, and even short terms in 2021. Simon, can you maybe talk us through what's behind some of those performance trends?
Yeah, look, I think that's great. Again, in this report, we see really strong performance from responsible investment funds. And that's something, we've done these reports for 21 or 22 years now, I think 18 years standalone reports in New Zealand, or New Zealand data on this. And we do consistently see really strong performance by responsible investment funds against mainstream benchmarks over short, medium, and long term. And again, that's been shown to be the case. When we unpack that, looking at global studies as well as our own study, we see that effectively a systematic approach to analysing ESG risks and avoiding the riskiest sectors or managing for them actually helps to underpin stronger long-term risk-adjusted performance, which is great. This is entirely aligned with delivering strong investment outcomes for our clients. I think what's really important in this data is we see that what's driving this is not just anyone saying they're doing responsible investment is going to be better than the benchmark. It's actually those leaders who, and Zsuzsa put up the slide before, the definition of what the leaders are under our assessment framework. And it's those fund managers or investment institutions who explicitly and systematically manage for ESG factors in their allocation of capital. It's those that can be sort of transparent and report publicly, i.e. they can actually talk about what they're doing, their processes, their practices. They're talking about their activities, but also the outcomes they're achieving. So those results really are reflecting that people who comprehensively are undertaking responsible investment are managing risk better, avoiding the downturns better, seeking overall to and are achieving better investment outcomes, which is great news. So I think that's great to see. The certified funds there, we had data for the first time this year. It's a smaller pool of funds. It's really detailed product level funds. It's really great to start analysing that. And it was really impressive to see that outsized performance of those products across different asset classes and time horizons as well. So I think this is really consistent with what we see with a lot of studies now. We're an industry that's been around a long time, so there's a long time series of data, and it seems to consistently show us this really helps to drive better risk-adjusted performance for investors.
Pip or Erica, did either of you have thoughts on that?
Not really, beyond, I guess, Simon's point, and you know, I guess the all research now kind of agreeing on the same point, which is managing your ESG risks is managing your financial risks. And you know, time and time, I think every year, Simon, we see the same results in these reports and all the reports globally. So I mean, it's just still slightly disappointing maybe to see one of the big negative drivers come through as a disbelief in something which, you know, you'd almost say, you know, it's kind of undebatable. I can see that obviously, and maybe we see this increasing in the USA at the moment, there is almost kind of the anti-ESG movement growing, which is, you know, maybe if there's a small universe that is excluded from a lot of investments, that potentially there is some financial outperformance areas. But you know, I guess globally, that through all surveys, the argument is I'd say well prosecuted that doesn't seem to be true, and we see that again this year, I guess.
Apologies, I managed to mute myself, just have a wee cough. Erica, did you want to jump in on that, I guess, both from an American perspective, but also looking at it a bit more globally?
Yeah, you know, I think that what Simon and Pip had said was well put. And I think that, you know, ESG information, you know, and going back to ESG integration, it is really about, you know, where material incorporating these ESG factors or sustainability factors to give, you know, an investment process, you know, more information for making, you know, better risk adjusted investment decisions. And, you know, that, you know, may or may not come through in, you know, an ESG, you know, process and by way of performance. So, you know, again, I think that there are funds that have, you know, ESG and sustainability objectives, you know, where they're looking to kind of meet those very specific, you know, ESG, you know, optimized or, you know, exclusionary screens for investors. But, you know, that aside, you know, ESG factors do have a role to play in an investment process as well, you know, where material.
And just a reminder to everybody, we are taking Q&A through the Q&A function. And first one of those that's come in is probably a question potentially best for Pip to start with. What do you see the impact of New Zealand's relatively small market size having on our ability to effectively apply engagement as an option? And I guess what that's essentially asking is it harder to do good engagement in New Zealand because either the assets are smaller, or I guess, as you alluded to already, you know, some of the organisations are potentially smaller and it can be a bit or perceived to be more resource heavy?
I guess it's the same situation for everything, you know. As an individual, we've all got one vote, but as we all vote, we find that we do have the ability to have a small influence on large changes, and that's, I guess, the same in all these types of things where we have arguments that you know, New Zealand's too small to impact global emissions, or our investment size is too small to impact the behaviour of companies or your change norms, I guess. And there's a couple of reasons that you know that is an issue. One being there seems to be, I guess my biggest issue with that type of argument is there seems to be a view that if we do nothing, we will be better off because we have saved money by, you know, not in this case, not furthering our corporate engagement plan and the costs associated with that, when all the evidence really points to the other way, which is these things are actually going to help you improve your risk management processes. Similarly, in climate change, there seems to be a view that if we do nothing, we are going to save money because we haven't had to invest in transition technologies, etc., and therefore we'll be better off financially than maybe those that do transition earlier. When again, all the evidence really shows that if we do nothing, we're all going to be worse off, everybody, including those that do nothing, and actually those that take advantage of the opportunities and prepare themselves better for these future changes are going to be better off in the long run. So I guess I find that it's an argument that does come up quite a bit for not being a leader in particular, but however, I would suggest that if you investigate the evidence that's behind that assumption, that it doesn't actually add up to that conclusion.
Simon, you're nodding along. Did you have something you want to throw in there?
No, I thought that was just spot on. You know, like there's really, we're at a point where the BAU has a cost. BAU do nothing scenario has a cost right now. So I guess I'd just sort of reiterate that as well. And I think we're seeing that in the data where that has been made aware. You know, we're talking about system level risks now where everyone is exposed to these risks across an economy. And so being a small fund manager or a small KiwiSaver provider doesn't reduce your exposure to the risks, and hence the sort of the argument to take action on these and collective action, which is often necessary. It's great to see that kind of that awareness rising. And then I just sort of saw an interesting question come up there, Dean, if I can jump to it from Katie, just around one of the constraints being around, or one of the deterrents being a lack of product. And you're right, we're seeing a additional products been available in the NZ market. We've seen a huge growth in certified products in the NZ market, which is really great to see because it has been traditionally a constraint that we've seen and heard a lot from across the market. I think there's probably something of a lag factor at play there, though, in terms of when those new products have sort of come to market, reach their sort of 3-year performance hurdles and start actually unblocking that constraint a little bit. So we've certainly seen a distinct response to that call out of a need for new products. And probably this last year in particular, a huge number of products coming to market to sort of service that demand. So I think that's one of the deterrents in the marketplace that will slowly fade over the next couple of years as they sort of come to market and are proven up, and we see people starting to allocate to new products. And then of course just getting them in the infrastructure on the platforms available to advisors, getting them out there across the market for ease of distribution will be sort of the thing that plays out. It takes a little bit of a time, so I think it's a slight lag indicator on that one from my perspective.
And just for clarity, because I don't know that everybody can see that question, it was specifically relating to why would a lack of viable products be one of the key deterrents, given what has been really clear and obvious growth in terms of the market, both within certified products that RIAA sees, but also those sort of products that are coming down the pipeline. So that was kind of specifically relating to that question.
Sorry, Dean, can I just mention that in some of the answers to this question and in relation to lack of products, some of the observations in the comments was around the difficulty in developing new products. So in terms of resources, it takes a long time. So it's not just that there isn't perhaps a lack of, but the difficulty around actually developing, and that leads to this lack of products, or which wasn't a separate category, but perhaps next year we will put something like that in there.
Excellent, thanks, Shusha. Moving on to, I guess, some of the challenges and some of the things that potentially we're seeing aren't doing as well. It's clearly been identified that allocating capital to target sustainability outcomes is an area where we saw both leaders and non-leaders perform the weakest this year. That's similar to what we saw when we did this research last year. I guess it's hard not to make the assumption on the back of that it's really difficult to demonstrate capital flows achieving real world outcomes. I'd be interested to get the panel's insight into why we think that investment managers are struggling with this and potentially what makes it so hard.
I'm happy to start. What makes it hard is data. Calculating non-financial metrics opens up, I guess, a raft of problems, which there is a lot of people trying to work on and improve, but also kind of, I guess, standardize and make these types of things easier. But there is a lack of information around non-financial information, first of all. So as soon as you get out of things that probably aren't really the norms, like say greenhouse gas emissions, it can become quite challenging to first of all find information. Secondly, information is very subjective in terms of outcomes. So there is some challenges in kind of creating robust metrics, which I think can be a bit of a deterrent in the space. And I guess in comparison, other options may seem easier than kind of reporting around impact or reporting on the positive outcomes of investments. Maybe one other thing just to kind of add in there, and I think, unless I've misinterpreted this, the growth in the sustainably linked loan market has been categorized as sustainably themed investment this year. And that's, I think, led to quite a bit of the growth, particularly in the non-climate change areas from my interpretation of the results of the analysis. I think that is quite interesting and a potentially one way we are kind of standardizing or normalizing this expectation that we are getting information and reporting on the improvement in non-financial information. And it might be things like these products as they roll out that start to really make an impact in terms of, I guess, that data gap or that data void, and make this an easier strategy to implement. Really interested in others' thoughts.
Yeah, so I think, Pip addressed it well with respect to the data quality and disclosure issues. So, data does exist today. Largely, kind of the metrics that are available are really around kind of some more of the environmental, metrics. Things like whether or not an issuer is Paris aligned or has been a signatory to science-based target initiatives, even some scope, greenhouse gas carbon scope emissions data. But largely, the transparency and also the consistency around large data sets, particularly in some of the social categories is really lacking. So, I think there needs to be a meaningful improvement there with respect to data, and it is improving, as managers work closely, as we talked about from a stewardship perspective with issuers to improve the ESG related data and increase the transparency. There are also efforts from a policy perspective, that are underway around, mandating that certain data is disclosed by companies and other issuers. So that will certainly be helpful. And then, I think also having documented processes and frameworks that inform materiality of ESG themes with objective outcomes and goals, is also important for, showing the impact that a manager can have. We talked about the engagement program as one way of driving positive impacts and improving ESG performance. So, looking to improve an issuer's overall sustainability aspirations or engaging on areas like COVID-19 resilience and responsibility or supply chain management, having these kind of quantifiable targets and developing really robust strategies to show improvement over the course of time will ultimately, enable, managers to show the improvement and the positive outcomes with respect to their investing strategies.
And maybe to follow on about that, because I'm pleased we're all excited about this area, because I think this is, really that's kind of the third wave for us. We've kind of done avoiding harm. We're doing managing ESG risk really well. Now we're really about how do we direct capital to achieve positive impacts and direct to sustainable assets. And I think there's a lot of work going on there as we're here in there, and this is only going to increase and become what we really need to end up seeing is capital flowing, and we are starting to see that impact of capital flowing preferentially to more sustainable and greener assets, and that the scale is going to come over time, and we're seeing the first parts of that, the doubling of funds under sustainability thematic funds this year being an indication of that. this is an area that's sort of been pioneered and tested a lot in the impact investing space, and perhaps, in terms of the methods and approaches and measurement approaches, is really important lessons being learned in that area that will spill over and are spilling over to other parts of the responsible investment approaches and strategies, such that we can get better at targeting and measuring and managing that broader impact. So I think this will continue to grow a lot. I think this will come through in both the specific products coming to market, and a lot of those new products are thematic sustainable products that we're seeing come to market over the last couple of years. We've seen a wave of them coming through to respond to this really dedicated sort of demand for such products. But equally, it's going to happen across other approaches, and other asset classes are built into the mainstream portfolios where we're going to be able to affect really significant change. So we kind of need it all. We need it across the thematic and the impact products, but we also need us to be thinking about how we do ESG integration for impact, and how we do, stewardship and engagement for impact. And so I think there's a really big area for us to watch, an area where spending a lot of time on sort of perfecting, refining how we do that. And it's great to see those early numbers starting to tick over, with capital actually flowing preferentially in that direction.
And Simon, maybe just to add to that, because you just mentioned something that I think is a really good point, which is this kind of, I think you mentioned like the next generation of product in a way. And we are at this point where, we have sustainability metrics or non-financial metrics, and then we set targets and we improve upon them year on year. That is different to really saying something's sustainable. And when we use that word sustainable, we actually technically mean that it's kind of inside the environmental boundaries that our planet can sustain, and also provides kind of the social benefits that are minimum required by society. To say that something is sustainable is significantly more complex than improving your performance against certain environmental and social KPIs. And this is an area that there's a huge focus on with things like the EU taxonomy, which is trying to set out an actual definition per sector of what actually is environmentally sustainable, what actually kind of operates within our environmental boundaries or planetary boundaries. And that's a massive step. And as you said, Simon, there's a lot of work going on. There's a lot of complex standards and things being developed, both internationally. Australia has just released, I think this week, its first kind of papers on what a sustainable taxonomy might look like in Australia. And similarly, we've done a similar project in New Zealand on the ag sector. So there is a lot of work going on. It is, to be honest, still it is still developing, and to try and make this something that's digestible and simple and where the complexities are balanced with the benefits is really the challenge. And we will, I think, continue to see this space emerge and become increasingly important as those greenwashing concerns probably increase as well.
Simon, you briefly mentioned that we saw a doubling in the volume of capital going into sustainability themed investment. While starting from a lower base, absolutely, that's a really significant factor, which I guess if we hope to see that continue into the future, will have a bigger impact over time. What does, and this is a question for anyone on the panel really, what do you see as driving that trend, and what are the kind of things that we're starting to see come through that will lead to that capital ending up in sustainability themed and impact investments?
Yeah, so I think there's probably a couple of critical and quite different and distinct drivers here. One, I think we've gotten to a point in this sort of net zero commitments around climate change to understand that somehow we need to get to 2050 and to achieve net zero, and we're putting in place these targets, and all of a sudden the screws are sort of tightening over the last year, where we all of a sudden realize that means effectively a 7.5% emissions reduction year on year for the next years out to 2050. And so we're looking at all the options, I guess, in terms of how we get there, and part of the answer to that's going to be finding investments in lower carbon technologies, companies, those that will help drive that transition. So I think there's going to be this sort of demand from an institution who's trying to seek out that exposure to those sectors of the economy that are going to be the winners as we transition an economy. But I think the really important driver here also is consumer demand. And I think that's something we see come through a lot in our consumer research in the NZ market, where whilst consumers are wanting to invest ethically and responsibly, and that's the vast majority of Kiwis are saying that's their expectation. Many are just considering avoiding harm is now a given. You know, they just expect that a KiwiSaver provider or fund manager is avoiding the most sort of egregious and controversial industries. Actually, where consumers get excited is when they can see their investments being committed into things that create positive change and support sustainable businesses. And so I think there's going to be this demand there where actually we want to get exposures, consumers want to get exposure to sustainable industries, the industries that are going to thrive in a transition and a low carbon economy. So when you consider that awareness from consumers in the NZ market has risen dramatically in the last 2 years. So it's up 13% in the last 2 years, reaching about 77% of Kiwis telling us they're well and truly aware of responsible and ethical investing. Of those who aren't yet doing it, 2/3 are telling us they're planning to invest responsibly or ethically in the near future. And then you see the sort of themes that are coming through in some of this data, and I just see climate, sustainability themes, negative screening, engagement. That's really driving a big side of this demand. The desire for consumers, citizens to actually take action through their pensions, their investments, their savings to actually help support that transition, take action on climate and invest in those sustainable industries. So that seems to be a big part of that driver.
Yeah, and I would agree with Simon. There's definitely a recognition that climate change presents this escalating threat to the planet and to communities, and that's definitely driving a lot of consumer interest. But increasingly, there's an awareness among the investing community that climate change has this propensity to really impact economic and market dynamics. But it's that, what is the order of magnitude, right? That is going to kind of shift the needle from an investor perspective that we're trying to solve for in getting to this kind of transition state. And so as a result, we're really seeing this global mobilization across the ecosystem among corporates, sovereigns, investors, asset managers, and really accepting the role that needs to be played and reaction in turn. And we're seeing this, witnessed by investors' efforts to back new technologies, shifting from brown technologies and industries to green. We're seeing, work among policymakers on proper regulatory and enabling frameworks for a transition economy. Governments are also pledging to support climate action on a number of areas like methane emissions and ending deforestation. And then from a company perspective too, we're seeing increasingly, companies stepping up their commitments and action on climate-focused strategies, investing in renewable technologies, and making commitments to cut emissions in their business and in their overall firm. So I think it's this kind of broad acknowledgement and action and implementation among these commitments that are really shifting capital allocations and opening up opportunities for climate-oriented investors in these sustainability-themed investments, like climate strategies in particular, that are driving kind of this trend and what we're seeing in the results.
Just thinking about that consumer demand, do you think, and particularly as it relates to climate, I think one of the things we've certainly started to see more recently in New Zealand is that the impacts of climate are now starting to become much more tangible in terms of their impact on us. And for example, I live in central Otago. A couple of weeks ago on Tuesday afternoon, I was telling my kids off for being outside without sunscreen and getting sunburnt. And by Thursday morning, we were building snowmen in our backyard. Conscious that, Simon, you're based in Victoria, Erica, you're based in California. Those are areas that have seen and had the impact of climate, much more tangible. What has been the impact of that historically? Have you seen that translate to increased consumer interest and consumer action?
So if I start, I think absolutely in the Aussie context, there was no doubt that the bushfires over the summer of 2020 triggered this massive increase and step up in consumer interest in how they could respond to climate change through their own investments and super. And so we saw a huge awareness, a huge increase in demand, and a significant shift that year that was catalyzed by those bushfires. So I think these events, it felt like a penny drop moment, I think, for people, realizing that, and particularly in the political context we were in Australia at that time, with a government who wasn't showing strong leadership on taking climate change action. I think people were looking at where else can I have an influence and they landed very quickly on their retirement savings, their superannuation, their investments. And so that has absolutely flowed through to pressure on our members as super funds, as banks, as investment managers, to be stepping up, to be demonstrating the action they're taking, and certainly has actually triggered flows towards products that are presented as climate solutions or playing a positive and constructive role in managing for climate change risk. So we've really seen that impact directly via consumers in the Aussie context.
Yeah, and with respect to, California, we're also, not immune to a lot of these kind of climate, related, weather events. We too had significant fires. We were in a multi-decade drought in the state, and as a result, there is definitely an awareness among, those that live in these areas that are affecting it, really the personification of these climate events and climate change, bleeding into their decisions. Unfortunately, as climate-related events happen throughout the world, and they are felt in areas, where we're growing our food, or where we are, causing, migrating populations to leave their homes and their communities as a result of these issues. It will become more of a front of mind issue. And from an investing perspective, we're thinking about, what the cost of this means to agricultural commodities, the inflation of let's say wheat and corn, as where we grow our food globally becomes dislocated as a result of climate change and these sorts of weather events. So again, it kind of goes back to what we talked about before, but increasingly, ESG factors, are becoming more relevant and material to an investment process. May not be with respect to, making a decision in isolation, but certainly as another data point to make a more informed risk-adjusted return or risk and opportunities informed decision.
And Pip, do you think that will flow through to New Zealand, or are we already seeing that flow through in New Zealand?
Oh, look, I kind of go back to the recent Australian elections for signals of how you see things flow through. And I think, and Simon, you're probably better placed to talk to this than me, but from watching that from New Zealand, the floods obviously were significant in Queensland just before the lead up to the last federal election. And it was Queensland where actually the election results to me were most surprising, where we actually got a Green member in, I think, for the seat of Brisbane, in a state that's traditionally, traditionally quite liberal or righter wing. So I think we do see these things. I guess one thing that is challenging, particularly in the New Zealand landscape, is they do tend to follow significant climate events, and potentially we haven't had one of those really significant events, and potentially people's concerns then kind of normalize over time again, and then increase and then normalize over time. So it does seem to me that we do get this sharp, as Simon, you spoke about after the floods, after the fires, a sharp spike in concerns after an extreme weather event or something where we can start to see climate change actually occurring that then starts to drift off a little bit with time before spiking again. However, I guess what the take I take from it is that there is a trend over time, which is increased action on climate change. If we are expecting increased physical risk to continue, you're probably only going to see that trend exponentially increase. We are also seeing a trend in terms of global regulation. So should we have a change of government next year in New Zealand, and regulation potentially might shift with that as well, it is going to be hard, similar to maybe what Australia experienced in the last 8 years or so. It's going to be hard to separate too far from international norms if that is the group that we still want to be investable to associate ourselves with, to have trade agreements with. And it's likely that those types of issues are going to increasingly become important.
And while I've got you, how much do you think the legislative and the policy environment in New Zealand has driven the growth that we've seen in this report?
I don't think, I know we've talked about it being important, and it sets the structure of the New Zealand report maybe versus other regions. I would, again, be interested in in RIAA's view on this, but I don't think it's a trend that's happening in isolation in New Zealand. I think it is a global trend, and regulation actually is significantly stronger in places like Europe than potentially it is in New Zealand. So there potentially is the view that we are a leader, and I actually, my view is that that's potentially not really the reality. We have high ambitions. We have values that are aligned to the, you know, to ESG more than other countries, but I'm not actually sure that we are quite the leader that potentially, you know, we do read about sometimes. So I guess my view is that the regulation potentially drives the nuances of the New Zealand market, like the significant negative screening proportion. However, the trends to me are more something we're seeing globally, and something that, you know, we're unlikely to kind of decouple from, because again, we are obviously highly reliant on international capital. But Simon, again, I guess you get to see these results in a broader set of countries, so interested in your views.
Yeah, I think what probably we're seeing in both our markets at the moment is the legislative progress and the formalization of regulations are just moving this from an optional part of the financial markets to a compliance-based part of it. So it's making it no longer optional for a majority of the financial markets in New Zealand, and I'd say in Australia, when you're moving towards, you know, legislated climate-related disclosures, when you're seeing this built in as default requirements in the pension scheme in KiwiSaver, there are elements here that are quite leading in terms of the timing of their implementation. But I think you're right. I think there are other elements where, you know, as a market, I think it's doing really well, but there's still lots of areas for strengthening and improving. I think the change in both Australia and New Zealand in the last year to 2 years has been just moving responsible investment into a compliance-based kind of mindset, where we're now no longer only talking to the head of responsible investment or the head of ESG. We're talking to the lawyers, the marketing teams, the compliance teams, the senior executives. This has become something that's firmly on the desk of a central of a risk or a process to manage. So I think that optionality in responsible investment has gone now. I think governments have indicated enough through that. Things such as FMA putting out their guidance on greenwashing is another example of that, where this just becomes a stronger concern. I think you're right. There are strengths and there are less strong areas in the NZ market, like most other markets. So yeah, I guess in summary, policies played a really critical role. But even in the NZ market, even some of that policy has been actually driven by industry. You know, the industry collaboration that pulled together the sustainable finance roadmap that's now being led by Toitu Tahua and Centre for Sustainable Finance, I think is a really critical piece that actually, in a sense, industry is pushing government to give it the direction and the requirements and some of that guidance. So it's, yeah, lots of factors at play, I guess, all driving this.
Erica, do you have a view? I mean, you're about as far away from New Zealand as you could get. I'd love to get your insights into how you view New Zealand as a legislative economy or otherwise.
Yeah, well, I can comment maybe more broadly on policy, which I agree with Pip and Simon. It does play an important role in sustainability investing, and it will continue to evolve and increasingly play an important role as it relates to, promoting consistent, comparable, reliable information that investors and asset managers, will use in kind of managing more responsible investing products. Lack of specific disclosure requirements related to ESG investing has contributed to regulatory and industry, concerns around greenwashing, as Simon pointed out. So I think as a result, policy is evolving to consider these issues and really to address them on behalf of investors. And so, in the US in particular, regulators have put forth a number of proposed rules around ESG, including a proposal that would seek to enhance and standardize climate-related disclosures for investing. Companies would be required to disclose certain climate-related information about their business practices, including, risks, strategic implications to operations, their financial conditions, the amount of GHG emissions associated with their businesses. So, while this is still just in proposed reduced format, I think that directionally, we should expect to see, more evolution of regulation, which, again, in turn, should hopefully promote, more consistent and comparable and transparent information that will benefit investors in the investing community at large.
Thank you so much, Erica. Look, moving on to final question, and huge thank you to those who have been contributing via the Q&A. I'll give you 1 minute each. What I'd be really interested to know, we obviously do this every year. This time next year, we're going to be sitting down, looking over, a whole new data set and hopefully a lot more progress. Again, I'd love to get 60 seconds or less. What are your predictions for either what that looks like, or even in the medium term, if you wanted to go a little bit further? Simon, I'll put you on the spot first.
All right. So I think this has a long way to run yet, and I think that's the starting to really visibly see the flows of capital to sustainable assets, that sort of third plank, I guess, capital moving to support the transition to green and sustainable assets. I think that's going to be the big movement we see in the next few years, and that's going to be a critical part of that transition. And I guess that's going to come from a few factors, but what we know is that we're going to need every approach in the responsible investment toolkit to drive that transition. So it'll be about more engagement, more stewardship, more investors stepping up to kind of influence for change, agitate for change, and more sustainability themed and impact investing. So I think that end, where we're actually pushing for change, directing capital to support the transition and more sustainable businesses, is going to continue to grow really rapidly.
Brilliant. Thank you, Simon. Erica, you're up next.
Sure. Yeah, no, happy to. So, I think, the sustainability journey is one that we're on. It's long, and I think it deserves the appreciation that it will continuously evolve. We need to, learn from that, develop, and also adapt to it. From a themes perspective, environmental, particularly around carbon, methane, net zero, those I think will be themes that will persist in the nearer term. But I think that social themes and will particularly become more relevant and hopefully more data and metrics for investors to use as it relates to certain social values alignment will come online. I think to Simon's point on engagement, the engagement efforts, but also showing the impact that the engagement efforts have will be a focus. And then, innovation in terms of product, we didn't talk about it, but, ESG bonds or GSS bonds were highlighted in the report. And I think that this is going to be an increasing area of growth and innovation. We've seen a tremendous amount of growth already, but, we think that sustainability and sustainability-linked bonds, for example, will open new doors of capital for issuers that have more of these sustainability objectives and targets and commitments in the future.
Terrific. Thank you, Erica. Pat?
Sorry, just struggling with the mute button. I don't have anything revolutionary to say. I think we'll see a lot of these key trends continue, similar to what Simon was saying and Erica was saying. So I think we'll see the increase in respondents. We still have seen, even in the last year, a massive increase in interest and engagement in this space. And so I think we'll continue to see that the number of people that respond to the survey will increase. We'll see increases in the trends we have seen, like ESG integration, etc. And then maybe to kind of throw out a few areas where we might see quite significant change. Hopefully the stewardship code will drive a significant change in the reporting on outcomes of corporate engagement. That would be really great to see flow through. And similarly, I think we'll see this increase in sustainability or impact investment increase, where people are targeting and reporting on the outcomes of their specific investments. And that will be broader than just climate change, as these other, particularly environmental issues, continue to kind of increase. For instance, sustainable agriculture, which is about water management, fertilizer management, soil management, climate change adaptation and mitigation. So I think we'll see that kind of categorization and the language expand a little bit more beyond climate change.
Terrific way to wrap up. Thank you so much, Pat. And thank you so much to everybody who's taken the time to join us this morning. In particular, would really like to make sure we take the time to thank the RIAA members who contributed the data that allowed us to pull together such a comprehensive report. Sorry, congratulations again to the leaders and those who have been able to demonstrate again that they are pushing the boat out in terms of what's happening within the industry. Likewise, congratulations to the report author Zhuzhib and Helmi Zakar, and a big thank you for the presentation and the detail this morning. Finally, thank you to the panelists, Erica Kinsella from PIMCO, Pip Best from EY, and of course, Simon O'Connor, the CEO of RIAA. Thank you so much for joining us and delivering your insights. Hope everybody has a fantastic afternoon. Ngā mihi nui.